Welcome everyone to All-Star Financial's fourth quarter 2010 webinar. This will be our third webinar. We've had a lot of great feedback that people are enjoying the webinars. Those people who can't get in can just go to our website, plug into the webinars, and hear my voice and comments behind what we think is going on. So another thing too is please feel free to send this to any of your friends or family that might be interested or potential clients. So typically what we like to do is talk about kind of where we're at in the economic modeling system. So if we can kind of go to the economic wheel again, we know we've gone through the recession right now, and leading up to that, where we're at right now, we had to stop at the 630 mark where we were kind of at a little bit of hope back then. We were definitely seeing some stabilization in the economy all the way to 930. Didn't move a whole heck of a lot. Very, very slow pace. Stabilized a little bit more, but still some vulnerabilities. Well, we think to close of fourth quarter 2010, we made some really good strides. That the progress was significant, and we're to that point where I think you can even say yourself that we're looking at some pretty good optimism out there. Small caps doing really well. So we know we're kind of at that little bit before 9 time period. If you look at the market overview on a whole, we saw the 2008 crisis, the financial crisis, really take us down to some fairly significant levels, down almost 57, 58%. From 07, but from 08 we are actually back to those financial levels, the indices I'm talking about. But in looking at real dollar terms, if you look at from your accounts or most people's accounts from 07 to today, most people are still underwater dollar-wise. Well, all of your accounts, or most of our accounts, all but very few right now, are even or actually positive. So really, really happy with that. Over a very short period of time, we were able to come back and earn those dollars back when most people are somewhere 30 to 50% still underwater. Had a really yo-yo year. First quarter was up based on earnings. Second quarter, we had a downtime period based on some sovereign debt problems with the GIP nations of Greece, Ireland, Portugal, and Spain. We had some good numbers in earnings on the Q3, and then some additional earnings increases in Q4, as well as some economic numbers. We also had a public offering from General Mills and AIG that helped pay back some of the TARP money, and that led to what we believe to be a pretty steady foundation for some economic growth going forward. Specifically in the economy in the fourth quarter, we saw numbers come out for third quarter at 2.6, which is kind of almost a quarter behind. Showed some really nice growth. Fourth quarter is predicted to even be better, which is really great. Consumer confidence on the personal income and spending is up about 3.8%, which is great. Jobless claims, always good to have jobs increasing, or at least not as many people claiming the jobless situation. Business spending's up both on the equipment and inventory level. Corporate balance sheets as good as they've been since the 1950 areas. Bank lending, very good sign. That frees some liquidity up in the market. That was up in November and December. And then always good low inflation rates and low interest rates are good for the economy overall. So looking forward, we think that the economy's been upgraded and the stability has been upgraded because of a number of things. Extended tax cuts, the unemployment benefits were also extended. 2% payroll tax, which is going to cut $108,000. 2% of that's a little over $2,100. That those types of wage earners are going to basically benefit from. Economic indicators are positive. The EDRA, Economic Recovery Index, the Confidence Board numbers are all good. Potential growth in hiring, I think, is really probably the next thing that we need to look at. And if inflation stays low, I think we have some really positive upgrades. We still do have some questions, though. Unemployment still remains a question in my eyes. I'd like to see a jobs program, investment credit for jobs if we could. And I've been preaching on that for a while. Hopefully they'll listen. And deficit-wise is still a concern. I think we need to see some fiscal prudence, and hopefully we'll get that. Bond markets for the fourth quarter was very volatile. As you know, when interest rates go up, bonds go down. We were about as low as we could on interest rates. We saw short-term government bonds go down about 1 to 3%, long-term almost 9%, and munis about 4%. And that was a big reason behind the volatility was money was exiting the market. As we talked about in the past, 18 months prior to 9/30 of 2010, the amount of money going from equities to bonds was astronomical, almost to the point of ridiculous, about $620 billion. And we just saw about $25 billion go the other direction from bonds to equities this last quarter. So that hurt a little bit. We had some unintended harm by the tax cuts. They let it expire, the Build America bonds, which forced municipalities to go through traditional financing, which is a little more expensive, and kind of the supply of that outstretched the demand, so prices went down in the bond market, we think momentarily or short-term though. Looking forward, we think the equities are going to be the place to be, so that'll hurt bonds a little bit, but the Fed easing is going to help that. They're buying debt as we speak. High yields are still strong. We had about a 3 to 4% gain, and that's our largest exposure in the bond market right now. Emerging markets is the second largest exposure, and most of the emerging markets have better fiscal condition than we do here in the United States. And we're seeing for the first time in a long time municipalities increasing their revenue, which will help the municipal bonds in the payback there. Domestic stock market, we saw a huge momentum in the third quarter, which really we parlayed that into some real good numbers in the fourth quarter. We saw large caps not do as well as mids, and mids not do as well as smalls. As we've always talked about, smalls always go first in the growth standpoint. When we come out of a recession, growth is always better than value. So we are overweighted in the small and the growth side, which benefited us. Then our two largest sectors were energy and materials, and both of those did stellar performance numbers. If you look at kind of going forward in the domestic market, I think optimism is high, very high. In fact, to the point of could it be good or bad, that people's thoughts are a little bit overextended maybe, or a little bit unrealistic going forward. In addition to the seven things that really that force you to be optimistic, we have a couple of other things that we have to look forward to, and that's valuations are cheap, financials and dividend-paying stocks we think are going to be pretty good too. Along with GDP, consumer spending, jobless down, business spending up, bank lending up, corporate balance sheets that are better and low inflation, valuations I think are going to be very good too relative-wise. If we look on the international side, right now, we saw fourth quarter numbers underperform the U.S. Should say fourth quarter here. I apologize for that. The EFI index and the emerging index, you can see underperform both the domestic. Both of those underperform the domestic market. The BRIC nations severely underperforming at 7.34%, and a lion's share of our assets were there. So we got hit a little bit there, and it hurt our performance. But looking forward, we still believe that the focus should be on the emerging countries. Earnings relative to growth are still some of the best PEG ratios around. The countries that are increasing interest rates, China, India, Korea, and Brazil, they have modest policy application to their raising of interest rates, so it's not going to be severe. And we just think the demand and population will kind of override all that is negative on the interest rate side. In Europe, we think Germany's okay. The rest of Europe is still going to struggle, we think, with the Greece, Ireland, Portugal, and Spain, the GIPS nations concern. Looking at a summary then, we look at kind of, is there still a risk for a double-dip recession? We don't think so. We think really the big question is the pace of the economy, not if it grows, but how fast it grows. We'll still see some volatility there. That slow but sure expansion, though, we think could be a real positive, that we could expand for significantly longer than a 5-year time period if it's done right. We do still have some potential problems, however, and those concerns are still unemployment, government mistakes as far as monetary or fiscal policy changes, and then housing. Housing is 25 to 40% of our economy, and we want to make sure that that comes back sooner than later. When focusing on kind of the less volatility question and our discipline, has it still benefited you even as the markets bounced? And you can see that our numbers are still very good. Remember, alpha is the measurement of return you received over the return you should have received for the risk you took. So the income portfolio, we took on 42% of market risk with a beta of 0.42. Still outperformed the return we should have got by 3.77% per year the last 3 years, and almost 3% per year the last 5 years. So about 14 to 15% value added the last 5 years. That's pretty significant. Balanced portfolio, 59% of market risk. As you get closer and closer to market risk, it gets tougher and tougher to create alpha. But all positive there, all positive on the conservative growth, and all positive on the growth relative to the Russell 3000. So a real quick thank you for all of you who are listening in, both clients and potential clients. And again, we'd like to implore you that if you have any questions, make sure you give us a call. We are at your beck and call as much as we possibly can. I will look forward to hearing from you if you have any questions. Also, if you'd like to, again, send this to family and friends, or refer them to our website, www.allstarfinancial.com. Go down to the bottom left-hand corner of our homepage and click on the webinar. That would be awesome and appreciated. You guys have a great day, and I appreciate all your confidence in the All-Star team.